Are stocks a good hedge against inflation? Well, here to talk with me about this is Massey DeSantis from Desmo Wealth Advisors. Massey, welcome.
Hi, Bob, and welcome everyone.
Yeah, so you just wrote an article about this topic for Retirement Daily. It's certainly top of mind given the latest news about inflation coming in at 8.5%. So walk us through what you wrote.
Yes, I mean, it's a great question. People are trying to understand what they should be doing for their financial plans. And, we hear a lot the thesis that stocks are a good hedge against inflation. And I think mainly that's based on the fact that stock returns tend to be higher than inflation over time. So in real terms, once you adjust for inflation, you're getting a positive return. However, a better question, I think, for investors is, and that's the reason why I looked into it, is okay. Well, real returns are positive once adjusted for inflation, but are they higher or lower or the same, in periods of higher inflation than they are in periods of lower inflation? I think that's really the key question, because if you expect lower returns, then you have to adjust your plan. You can't just say, hey, well, I'm invested in stocks and they'll outpace inflation. That's not enough for your investment plan or your financial plan in general. So that's why we looked into the question. And when you look at the data, if you look at the past 30 years, there's not been a lot of correlation between returns and inflation, meaning that inflation has not affected stock returns. However, we also coming out of the 30 years in which we have the lowest inflation. So, we basically didn't have inflation. I mean, some people argue that a 2% inflation is really not inflation because this CPI may be overstating inflation. So, we are a period without inflation. Is that a representative period to make inferences about that relationship? And so, for example, I'll give you one great example is during the financial crisis, 08 or 09, the biggest risk there was not inflation, but was deflation. The fact that prices might be falling, and that has a host of other problems. So if you see 3 or 4% inflation in 2009, you're happy. You're seeing that, well, the risk of deflation is very low, right? So we have to kind of look at the data and screen the data a little bit, and just be more careful, eliminate those years where we have deflation, and then look at periods of higher inflation. And if you look at more carefully in the data, the relationship is pretty strong that in periods of higher inflation, you have lower average returns. You can expect lower returns on average. Now, stock returns vary for a lot of different reasons. So this is not a prediction about what's going to happen in the next 5 or 10 years, because there may be other things besides inflation that are going to affect returns. However, I think in periods of higher inflation, you should behave as if maybe your expected returns are going to be a little bit lower than normal. And that's what we do in the paper. In the article we talk about that. We show a chart where if you actually look at the overall scatter plot of inflation and returns, there's not a lot of correlation. But once you focus on the periods of higher inflation, that negative relationship shows pretty easily. You can see it, and so that's what we try to do.
I guess one quick question about that is, given that you would still recommend investing in stocks, even though given your results from this research?
Yes, definitely. I mean, stocks are, stock returns are a gauge for what's happening in the economy, right? So they lead changes in the economy. So when stock investors think that there are good economic prospects, the economy is picking up, then that's where you see the higher returns, right? So what that means, if stock returns are expected to be lower, that means we may be going through a rough patch for the economy, but there's not much you can do about it, right? I mean, one thing you can do, obviously, within stocks is what I see a lot of times. A lot of investors are concentrated in the U.S. stock market, or even in particular segments or industries within the U.S. market. So I would say definitely diversify globally, stay invested in stocks, I think, and diversify globally. And then you may want to revisit your asset allocation, because if we expect lower returns, well, then maybe tilting your portfolio towards more equities might give you higher returns in expectation, they can compensate a little bit for the lower expected return. However, that increases your risk tolerance. So you have to, it's a trade-off. You have to think about that. So I do, to answer your question, though, I think stocks are still a good investment. I would also look at, diversifying more broadly, and definitely also in your fixed income portion of the portfolio. We give suggestions in the article about inflation protected securities, and that's typically government bonds, but not only that. You also find mutual funds or ETFs that actually have an inflation overlay on top of the bond market that they're targeting. For example, you could have something like an index, an investment grade index with an inflation overlay.
You also talk in the article, Massey, about some tips and tricks to help you save more, that you might want to increase your savings rate during periods.
Yes, I think so. I mean, definitely. So if you are planning, right, the expected return affects how much you need to save to get to your goals, right? So if your saving rate in normal times is 10% for your retirement, that's one of the starting point that we often cite, save at least 10% of your income. Well, maybe now it's time to save 11%. So make that adjustment. And how do you do it? Well, maybe postpone some of the bigger ticket items. I mean, it's a period of higher uncertainty. You want to be a little bit more careful, save more if you can. And so that's the first suggestion I would give. Obviously, if you're planning for retirement, you can also think about, okay, what is the effect of retiring a year later? Maybe that's what people need to think about. Be a little bit more careful with their decision making.
Right. And for folks who are in retirement, they may have to use a dynamic withdrawal policy too during periods.
Yes, definitely. So I think the biggest risk of inflation really is for people who are at retirement or in retirement. The first 5 to 10 years in retirement have an oversized impact over the entire retirement period, like 30 years. That's what we call sequence risk sometimes. But it's really, if you're drawing down from your portfolio and you have some unexpected bad years in the beginning of the retirement period, that may affect your ability to sustain income for the long haul. And so that's definitely what I suggest people to do is, maybe look at how your real wealth is doing. And typically what you want to see is in the first 5 to 10 years, you don't want to change it don't want to see it declining too much as you draw down from that portfolio. So, there is this rule, the 4% rule. I talk about it. Obviously, the 4% rule is derived from historical data. So it does include periods like the 70s where you had high inflation. And typically, though, nobody really starts with 4%. I mean, most of the clients, we start with a little higher level. And then maybe we go down or we make adjustments along the way. So if you're spending too much more than 4%, you may want to lower your spending relative to your wealth, closer to that 4% level.
Yeah. So I know we've covered a lot of ground, and I know you didn't necessarily cover this in the article, but everyone is wondering about inflation and how long it might last and how long you might need to make these adjustments to your portfolio. Any wild guesses around what the future holds?
It's hard to make a guess. I can tell you historically, when inflation gets to this level, there is a real risk that it may stay a little bit higher for a while. And so, we may be facing inflation for next year, 2-3 years, maybe even a heightened inflation. So think about, even if the CPI does not increase for a while, the inflation relative to a year ago is still going to be a little higher than average. Just because most of the inflation we've experienced in the second half of 2021. So that higher rate is going to be with us for a while. And there is a little bit of built-in inflation because typically wages are negotiated after you've seen the inflation rate, and that may increase, cause then costs to go up, and therefore firms are going to start to charge higher prices. So there is a little bit of inertia that gets embedded into the inflation process on the economy. So that's why I recommend to be on the safe side and save a little bit more, and that helps you then ride this inflation wave.
Yeah. And then for folks who like to watch the data, obviously there's the CPI, there's CPI, less
Yeah.
energy and food, and then the Fed is fond of looking at the personal consumption expenditures. Any
Yeah.
thoughts about what people should be focused on when they think about inflation?
Yeah, it's a great question. I think at the end of the day, look at your budget. How much more are you spending relative to before? That's your own inflation rate. And the CPI-U, I think it's the most useful for consumers or like us. Yes, the Fed will use the core inflation numbers, but that's because they use that number to guide their monetary policy. They don't want to overreact, in their monetary policy. And maybe, yeah, we should also think in those terms too, and not overreact with our plans. So definitely, look at the core CPI as well and see, hey, maybe if I see that the inflation, or it could be also even in your area, your geographical area, if you look at CPI and you go to the BLS, the Bureau of Labor Statistics, you'll see that they have statistics for different areas. For example, the South has a slightly higher inflation rate than the North states. And so obviously look at what's going on in the core inflation, but then make some adjustments based on your own experience.
Yeah. Well, Massey, we've covered a lot of ground. Anything we missed or anything that you'd like to reemphasize before we wrap up?
Well, I think, one thing that we're going to explore a little bit more in detail is kind of deeper to your question about what should retirees do, people that are, withdrawing from their portfolios. And so probably that's going to be one of our next videos.
Yeah, great. Well, look forward to that. Thanks again, as always, for sharing your knowledge and wisdom with our readers and viewers, Massey.
Thank you.